Hello and welcome to the CNBC-TV18's Mumbai studio. I'm Sonal Bhutra. With me, as always, is Pavithra Parekh, and you're watching MF Corner. So, Pavithra, it is the time when we are closer to the end of financial year, and we get that mail from the HR as well. Please declare your investments. And the most common one is, of course, the ELSS funds, because that's where we get deduction under ATC. Now that we are talking about new tax regime as well, we need to understand whether the idea about ELSS funds, has it gone down? What kind of returns has this particular category seen? Is this still beneficial for a person to go ahead and invest in this particular scheme? So all that and a lot more on today's episode.
Oh, absolutely. This is the best time to be talking about this entire category. By the way, some of the returns have also been really good, right? So let's invite our guests on the show. We have Kshitiz Mahajan joining us, co-founder at Complete Circle Consultants, and Salonee Sanghvi, who's founder of My Wealth Guide, also joining us on the show now. Kshitiz, Salonee, it's always a pleasure. Thank you for being on the show today. My first question is exactly this. Like Sonal was mentioning, Jan to March is usually the time when you see a pickup in ELSS investments. Salonee, let me come to you first. Do you think that the new tax regime has taken away some of this attention because of the fact that there's no deductions under the new regime, and the government has been trying to push that scheme quite a bit as well?
Right. So you're definitely right. As more taxpayers shift to the new regime, investments in ELSS will definitely decline. We're already seeing lower investments versus the previous years, because the new tax regime opens up investment avenues that are not dependent just basis the deduction. But that being said, 65% of the taxpayers are still on the old regime. So I think people are still opting for deduction.
Okay, that's interesting, because there are a lot of them who will still benefit from the old tax regime. Kshitiz, let me come across to you then. What's your sense been? Are we seeing the attention going away from ELSS funds?
In fact, just to add to what Sonal has said, my sense is that every month we are opening 12 to 13 lakh new mutual fund folios. And these are youngsters only. And still it benefits the old tax regime people who are less than 10 lakh salary to go for the deduction through ELSS schemes. I think this cult will increase only, and you'll see more and more people falling and into that bracket and doing ELSS for the tax saving. One has to spread a word. That's what you guys are doing through your channel. I think as new and new people are coming to this fold, irrespective of whatever we are saying, we have only 4.1 crore unique mutual fund folios, and we are adding on to this every month. You'll have this category doing further better than what it has done in the past. My sense is that it's just a beginning, and you'll see this ELSS category becoming bigger than what it is now. Yes, somebody who's having more than 10 lakh salary, it doesn't make sense to go for the old tax regime. But so you have young India, 50 crore people less than 40 years of age. So young people will come at a lower salary, and once they'll have that bracket where they start paying tax, I think tax saver will gain, ELSS will gain momentum from here onwards.
Okay, got that. Let's also talk about how the performance has been, because I was looking at some of them. They've actually done quite well, right? Kshitiz, coming to you on this, just take us through how this entire category has fared versus the benchmark. If you could take us through a 3-year, 5-year kind of period.
So in fact, BSE 500 is a broader benchmark for all this category, and on an average, BSE 500 has done 18.5, you can say 18.75 compounding type of return. So it's very mixed bag. If you see the entire basket, most of the funds are in line with what BSE 500 has done. 30% is little over above that what they have done, and some are below that what BSE has done. But on an average, the bracket is between 16% on a averagely good fund to 19% to 20% in 5 years time frame. Over 10 years period, we have seen there's a little change in terms of how it has performed, where BSE 500 has done 16.7%, it has given return. But many of the funds are able to beat that 10 years return over last 10 years. We should take into account last 2-3 years, index has gone one side only. So it's a broader index rally normally we have seen. But interesting part is, like, there are 11 funds which are there who has crossed 1,000 NAV. So normally we start at a 10 NAV in mutual fund. They have become 100 times. Out of those 11 funds, there are 2 tax savers. One is HDFC tax saver, one is Franklin tax saver. So, in itself, it's a big thing that we have tax savers who have gone 100 times. We keep on talking about 100 baggers in stocks. You have a tax saving instrument which is there in stocks. So I think the index, this category has done fairly well, where your Franklin has an average close to about 1350. It has gone, almost 134, 135 times. And HDFC have gone close to 1100, which is 1162, which is around 160 times. 110 times. So I'm saying that you should look at this category for those people also who one is tax saving, one is who want a discipline in their investing style also. So, fairly decent returns the category has generated.
Okay, so Salonee, let us take it forward. Now that we established that this has been decent, sometimes it has been mixed versus the benchmark. We've been receiving this query, and the question is, what should investors do after the 3-year holding period gets over? Should this be redeemed, reinvested in other funds, or you should just let it go?
So I think there are a few misconceptions that people have about ELSS funds. A lot of people mistake ELSS investments as just for tax planning, and that's why you get this question continuously. First of all, I think tax planning has to be part of your overall financial planning and asset allocation. The 3-year lock-in doesn't indicate a holding period. It just simply ensures that people don't redeem the funds early. And ELSS at the end of the day is an equity fund. And, investments in ELSS need to be evaluated like any other equity fund in your portfolio. A lot of people also don't realize is that ELSS funds, if you sell after 3 years, you still have to pay long-term capital gains tax, just like any other equity fund. So I would not recommend redeeming and reinvesting so long as the fund is performing well. Only in a few scenarios can one consider redeeming the investment in ELSS fund. One is if the performance slipped below the benchmark in peers, then you can look at redeeming it and shifting to any other equity fund. If you don't have funds to invest fresh money for ATC that year and claim tax benefits. And last would be, if the amount in the fund is very low compared to your overall portfolio, then you can consider exiting the fund to consolidate your portfolio and reduce the number of funds held. So in general, I don't think people should be redeeming after the 3-year period.
Okay, I'm glad you mentioned that, because I think with ELSS, sometimes that's just the way people think, right? That as soon as 3 years is done, you should move out. Kshitiz, let me come to you as well on this. While you've taken us through the average returns, if you look at some funds, they've done 35-36% in a 3-year period. It's been a pretty solid kind of performance, because this is ultimately an equity fund. What is your thoughts in this? And, if someone has stayed invested for 3 years, they're free to get out now. Do you recommend sort of reviewing the fund individually and looking at it, or how would you approach it then?
I think Sonal has explained it, but just to add to what she said, one thing which you need to understand, when you redeem equity fund, there's a cost attached to it. It's a 10% capital gain which you pay after 3 years on the gain which is there. So if you have some fund or some thought of investing into some place which can generate much better than that, then only you redeem. Because then you have to add that 10% element on the gain also in your next investment. So I think if the fund manager longevity is there with the fund, if the fund house focus is there with the fund, if you see broadly the fund has done decently well, I don't see a reason one should redeem. As I given an example in the past, that there are 2 funds who have now almost 100 times in ELSS category. So it creates a discipline, and compounding can come in ELSS funds also if you just hold it a little longer. The benefit which government has given is that you can hold it for 3 years and get a tax benefit. So that should not be seen as an element to redeem after 3 years, or maybe churn and again put into ELSS and take a benefit, because the cost of churning is high and one has to take into account.
Okay, all right. So, while we are talking about some of the benefits that ELSS would give you, the returns that have been solid in some cases, who should not invest in an ELSS scheme? Salonee, let me come across to you first, and then Kshitiz, I'll have the same question for you.
So, as we know, not every investment product is right for everyone. And I think the same thing applies to ELSS funds. So if we look at who should actually avoid ELSS funds, I think first, if the investor wants stable returns, because ELSS funds are essentially equity funds, so anyone who wants fixed or stable year-on-year returns should avoid ELSS. Second is if you need access to funds or you need that liquidity. Anyone who wants liquidity or flexibility again should avoid ELSS because of the 3-year lock-in. And lastly, equities generate wealth, but in the longer term. So your holding period ideally has to be at least 5 years. Anyone who's looking at anything shorter than that should not ideally look at ELSS.
Okay, and Kshitiz?
I think if you're not falling into tax bracket that you have to pay tax, you don't have to invest into ELSS. You can go to a actively managed open-ended fund. And very simple reason. One is that you keep the money fluid on your side. Having said that, I don't want people to redeem before 8, 10, 15 years because compounding will come only after that. The major portion of the money will start coming after 10 years of investing. But yes, it keeps the option open. If something happened with the fund, something happened with the fund management, equation with the fund, so you are very much open to redeem that fund and you can invest back to something else. If you're not in that category, there's no need for you to continue investing into ELSS.
Okay, understood. So that is on, who should look at this category, who should not. But now that we've taken you through that, we're going to get into a short break. On the other side, we're going to talk about the risks associated with ELSS funds, how much of your portfolio should really be there, and lots more. We'll be back in 2. Stay tuned. Welcome back. You're still tuned into MF Corner. We're talking all about ELSS funds, and we still have Kshitiz Mahajan and Salonee Sanghvi with us. So, let's now talk about what are the risks associated with it, how much of your portfolio should really be on it. Kshitiz, let me come to you on this. What do you look at as, the key risks that maybe someone should be aware of if they are getting into this category and if they are looking at a fresh investment here?
So where 3 years locking is a boon for investors so that they can't move out, it can sometimes, create some time of, delay or maybe some time of casual approach on the fund management side, with all due respect to all the fund houses. But in few of the funds, we have seen that ELSS is a drag in terms of their performance vis-a-vis their active funds, how it's working. So my sense is that we have to pick and choose fund carefully where one can see a rolling return of funds over the last 5, 7, 10 years time, because last 5 year returns are looking good because markets have done really well in the last 4 years. But I'm saying if you look over a period of time, like 10 years plus, how the things have done, how funds have done over year on year, it will give you some sense that you should look at what type of fund and just look at the longevity of the fund manager also with the fund. If there are a lot of changes in terms of the fund manager who's managing the show, because he's the one who's deploying funds for you and trying to generate some returns for you, just look at that also, because that is something which is very important. Here, the jockey is the fund manager who's going to run the horse. So I think the second point is this. Third point, on the fund side, I think one risk which is there is that just don't look at performance of your ELSS in 3 years' time. Sometimes what happened, we have seen this time in 2011 to 14, markets have not done well. All the ELSS or any fund for that matter has not done anything in those 3 years. So when you redeem, you will say, better would be, I would have done, let's say, some LIC or something else. But you take, in the long run, if you see this ELSS as a category for, let's say, 10 years or 15 years, there's no other instrument, tax-saving instruments, who will generate 12% plus tax-free return, which ELSS is capable of doing. So I think when you match your tax, locking period with your return, that also creates a problem. So one should be aware of the fact that you are deploying this fund for 3 years and it's a locking for 3 years just to give you tax benefit, not to give you returns. You should have at least 5, 7 years plus time in your head when you're deploying funds in any of the equity mutual funds.
Makes sense. That's the general rule, right? Salonee, anything you would like to add to that in terms of risks associated with this category?
So I think I concur with Kshitiz. The only other thing is, because it's for tax saving, a lot of people don't realize it's an equity fund. So one has to be ready to weather the risk, because equity is volatile and sometimes after a 3 year period also returns could be negative. So I think that's something that people should definitely keep in mind.
Okay, and considering that we've gone through all of these risks or everything that you should consider, Salonee, how much of your total investment do you think should be in this segment? Of course, there is a limit as well to how much you can really be excused on account of ELSS. But how would you look at this?
So I think first one needs to look at their asset allocation based on their risk-taking ability and duration of holding. Then once you have what is the equity component of your portfolio, ELSS would form part of that equity allocation. So the amount needs to be essentially based on that. So I think that's how one should look at it rather than just do a 1.5 lakh investment because that's the deduction you get.
Okay, take that point. You know, while we're talking about ELSS, there's this passive versus active debate that comes up every time when we're talking about equity investments. And there is the introduction of passive ELSS scheme as well. Kshitiz, let me come to you. What's your take? Which segment between the two do you think is seeing more attention? Is it the active side or the passive side? If you can explain that for our viewers.
Two things. Important is not passive or active. One should come into equity through mutual fund. That's the first thing. The biggest risk is not participating in this rally. Second risk is that, you should look at, if you're not looking at ELSS as a category for tax saving, then it's a big problem because that's one category which over the last 20, 22 years time, I'm not bragging about the returns what they have generated, but is very much capable of giving you double-digit tax-free return over next 5-10 years period as a compounding return I'm talking about. So passive, yes. In India, passive is also active. The way index is churning, I think it's more active and it's a broad-based rally what has happened. And we have seen that many funds, including ELSS and active funds, are not able to beat the index. So passive is another strategy where, just to make it simple, fund manager will better look at an index rather than managing a portfolio himself. He will put the ELSS money depending on what tracker he's choosing, whether he's choosing Nifty 50 as an exchange or 500, Nifty 500 as an exchange. He can put in line with mirror image of those stocks in his portfolio. That's called your passive strategy, vis-a-vis active strategy. So I think both strategies can coexist, and both strategies are very much capable of delivering good returns. It depends that many of the passive strategy has advantage of low expense. So if you are a little concerned about the expense part, then I think passive strategy is something which makes sense. Options are very limited as we speak because there are a couple of options which I know. One is from IFL and one is from Navi. There are limited options which are there. But yes, there is a scope which is building up. And as and when you see new players coming in the asset management side, you will see passive ELSS. Tomorrow you might see an ETF of ELSS also. That you might see where they might have this, wherein ETF can't trade before 2 years, or like how it works in sovereign gold bond funds, that before 5 years, if you trade, you have to pay full tax. And after 5 years, there is no tax, and on maturity, there is no tax. There might be a possibility of that also. But yes, the future is passive and ETF, which will come in India, but it will all coexist. So important is for you to invest rather than just, looking at passive or active.
Oh, absolutely. And there's also news, very recently that SEBI is looking to push passives as well and offer some kind of advantage there. So you never know, there could be more of incentive for this category. So Salonee, your take on this entire passive ELSS, schemes? I know there are very limited, just two, like Kshitiz was just mentioning as well. But do you think this is a good idea?
I think it's a great move, given most investors invest in ELSS only for tax and they don't evaluate the fund as an equity fund. That being said, again, given that there are 3 options today, and you can fund can only have an active ELSS scheme or a passive ELSS scheme, and it'll take a 3-year time period before they can transition from active to passive. So I think new launches would be only new fund houses or fund houses who don't have ELSS. So options again in the space are very, very limited. Also, I think the general misconception that passive funds are less riskier than active funds is not true, because both invest in equity at the end of the day and have similar volatility. So I think that being said, for someone who's not confident of being able to pick or analyze and pick a good ELSS fund, I think passive is the right way to go. And one can definitely look at the passive options that are currently there.
Okay, all right, that makes sense. Salonee, quickly, if you can tell us, we're a little short on time. Are there better tax-saving options than ELSS funds one can look at?
So I think tax-saving options fall in 3 main categories: equity, which is ELSS; debt, which is PPF, Sukanya Samriddhi, National Savings, FDs, NPS, etc., and insurance. So I think for a lot of people, insurance itself covers the ATC deduction, so they may not need to invest further in for ATC. Their investments can be in other avenues. If that is done, then again, we look at the asset allocation and, then divide between debt and equity. For debt, PPF or Sukanya Samriddhi for people with a girl child is a great option because, the interest is tax-free, and secondly, it's guaranteed by the government. So there's a lot of comfort there. The only risk there is because the lock-in is much longer, you don't have access to funds before that. And I think for the equity option, of course, ELSS is a good option based on the asset allocation. But I think if people already fulfill their ATC on the other investments, then they should rather invest on other equity funds rather than ELSS, because that will give them more flexibility. And I think also returns are better in that space.
Okay, understood. With that, Kshitiz, Salonee, we're completely out of time, but thank you for taking us through a complete deep dive on this category, which, like Sonal was mentioning, is so well timed, because we're also getting a lot of questions on this space. So thanks for joining us for that quick chat. With that, we're going to wind down on this edition of Mutual Fund Corner. Thanks for tuning in. We have closing bell on the other side of this short break.